Hi, everyone. This is Jason Bjerk of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest. He is president and owner of large bullion dealer Miles Franklin. He has over 25 years experience selling bullion, I believe over $1 billion in sales. Andy Schectman, thank you for joining me.
Hey, buddy. Good to be here, Jay. Yeah, it's actually 33 years and we're approaching $8 billion in sales. It's been a wild ride the last few years where, I don't know, it's we're doing more business in a week or in a month these days than it seems we've done in years and years past. So I guess if we're going to kick this off anyway with an appropriate description of what it's like, it's unlike anything I really have ever seen. And if price was an indication of demand, and at least over the last 3 years, then everyone would be fooled. And I think, the mainstream, certainly, who uses price as an indication of value and of demand, is missing this by a long shot.
And for listeners out there, we're going to ask the day that we're recording this interview. It's on Thursday, November 10th, 2022. Paper silver prices in US dollars are $21.66. We've had a rally today, shockingly, on a weak consumer price index number. So the inflation number was cooler or weaker than expected. And yet we had a nice little pop in paper, gold, and silver prices. Gold prices popped to $1,754. But you alluded to this earlier, the paper prices for the metal there's a big dislocation between that and what the retail investor is paying with premiums for silver coins.
Yeah, I mean, a massive dislocation. And if it were just that, Jay, I would be less concerned, because you could attribute that to inefficiency. You could attribute that to overextension, where you're just overwhelmed with demand. You are inefficient in production or capacity, trouble getting blanks, whatever lame excuse you want to throw out there. I can understand that, and as one of only 27 U.S. Mint authorized resellers in the world, certainly the U.S. Mint has in many ways shaped my career, but I look at it as the model of inefficiency. Now, before I really get to what I'm getting at here, if you just would have told me, as far as the U.S. Mint is concerned, that it were Silver Eagles, because they haven't come back down since more or less March 2020. They've been elevated. But if you look at the amount of business that the industry has done over the last 3 years, 98% of it has been in silver. And for the U.S. Mint to call me in June of this year and say, hey, we are going to curtail gold production by 50% into the second half of the year, really has me scratching my head. But I will just throw that one out there. But as far as just looking at it from the retail perspective, yeah, the demand is way dislocated from the price. But here's the thing. When I say, is price a indication of value or demand, if you look at what's happening on the London Metals Exchange and on the COMEX and the backdooring of silver out of SLV by the authorized participants, in the case of the London Metals Exchange, we've seen a massive bleed down of supply, and they are contracting at a massive rate, where the amount of silver in the vaults at the LBMA is about 300 million ounces. And, you're talking roughly about, at the pace that we've seen deliveries, where in July, over 46 million ounces were delivered off the exchange, out of the ecosystem, which is a really big deal, because when you talk about liquidity, leaving it within the LBMA or leaving it within the COMEX, even if it's not for sale, gives it immediate liquidity. When they leave that ecosystem, when almost 47 million ounces get delivered out, it's a one-way ticket. Ain't ever coming back. But at that rate, the LBMA would literally, in theory, be out of all silver by mid-2023. When you look at COMEX, over the past 18 months, 70% of the registered silver on COMEX has been delivered. not just moved to the eligible category where it's tied to a warrant and not for sale, but delivered. And the registered stockpile on COMEX right now is the lowest it's been since 2016 of 35,000, just under about 35,500,000 ounces. That's enough silver to cover 7,100 contracts. That's it. And that's the price setting mechanism of the world. We're seeing 1,000,000 plus ounces, it seems, every day being delivered out of SLV by the authorized participants, taking possession with share redemptions, which give them anonymity. But the bottom line is simply this, is that someone is draining the COMEX of metal. One last thing, at least in terms of COMEX and the LBMA. In one day last week or the week before, 5% of all the 100-ounce gold bars were delivered off of COMEX. 3 weeks before that, 45% of all the kilo bars on COMEX for the mini contracts, about almost 26 million ounces, were delivered. And when you talk about the significance of delivery, it is that all liquidity is lost once it leaves the system in terms of reassaying. This is a one-way ticket. And the biggest money in the world, the most sophisticated, well-informed, influential money closest to the information, is using the manipulation of price and of rhetoric to run cover for literally emptying the shelves of all of the physical metal before whatever they see coming comes. And so when I talk about a elevated price on retail, if it were just that, I'd be, yeah, okay, it'll correct itself. What is really making me really concerned, Jason, really concerned as a business owner, is that from the very, very top on down, the supplies are disappearing at levels no one has ever seen before, ever.
So do you think then that the lack of metal at the LBMA and then other metals at the London Metal Exchange is a lot of it due to the Russian sanctions, because they used to get the metal, either silver or base metals at the London Metals Exchange or precious metals at the LBMA from Russian mine supply. And then we have since really February, all these sanctions that have been put on Russia, and they haven't been able to source any more supply to diversify their supply away from Russian mine supply.
Yeah, it's interesting you bring that point up. You know, I've been talking for the past almost 3 years, and no one was talking about it, about this coalition, this group that was gathering against the West. And I talked about gold being reclassified tier 1. I talked about the Belt Road Initiative, which is a massive deal that people need to understand. Talked about the BRICS nations. I've been doing this for almost 3 years, and it's starting to happen right in front of us. And it being this coalition of countries forming against the West. So there was an article this week, that was picked up by Reuters and by Bloomberg. And the article said that central banks around the world bought 399 tons of gold worth about $20 billion in the third quarter of 2022. And these numbers come from the World Gold Council. Bloomberg called the buyers mystery whales. And they postulated that the mystery buyers were likely either China, Russia, Saudi Arabia, or India. Now, that sounds like the BRICS to me. The BRICS nations have come out and said they are going to issue a competing reserve currency pegged to commodities. Saudi Arabia just announced they're joining BRICS. And so I do believe that when you look at a country like Turkey as an example, Turkey bought more gold the first 6 months of the year than any country on the planet. They too announced they are joining BRICS. What is gold? The world's only other tier 1 reserve, according to the Bank of International Settlements, since 2019. So when you talk about who's buying the gold, you look at the numbers that the U.S. puts out. Their numbers haven't changed in years. So if the U.S. isn't selling their gold, but the export data shows that we've exported some 200 plus tons, who the hell's buying it all? It's going eastward. And whether it be Russia or India or Saudi Arabia or China, whether they're buying it through sovereign wealth funds on the Globex, whether they're getting it any other way off the Shanghai Gold Exchange or however else they're doing it, there is no question in my mind but that those countries that are forming an alliance and are going to issue a currency to challenge the world reserve status of the US dollar, and it will be pegged to commodities, and we can talk about that if you'd like, they're the ones buying it all. And I think that's why you're seeing it leave the ecosystem. You're seeing it leave the vaults. And when you talk about sidestepping sanctions, we're seeing massive drawdown on the Shanghai Gold Exchange also. I'll give you an example of how that happens. China, for the last 3 years, has been buying oil from countries with their Petro Yuan bond. The Petro Yuan bond is a bond denominated in yuan that is immediately convertible into gold on the Shanghai Gold Exchange. So you want to know how a country like Russia or Iran sidestep sanctions? They do it by selling their oil or their coal or their natural gas to China for the Petro Yuan bond and then immediately convert it into gold on the Shanghai Gold Exchange and take possession of it. And so, yes, the answer is yes. It is being purchased, I believe, by those countries where India in September imported as much silver as in the registered category in the COMEX right now, where today 13% of all the platinum bars on the NYMEX in the eligible category were delivered off of the exchange. Something's going on. You know, the concept of misdirection is so pervasive in athletics. If you ever played football or basketball, it's the no-look pass. In basketball, it's the fake handoff to the right and the whole line moves right, but the tight end squeezes out to the left. It's a screen pass. He's wide open. It's misdirection. In checkers or chess, you try to misdirect your opponent. Think you're going one way, but you're coming the other. You're thinking moves ahead. And misdirection is a very, I think, widely used tool in finance. And, you know, the concepts that are taught in the book, The Art of War, are mandatory reading at CIA and West Point. It's taught in most business schools on corporate hierarchy and in law schools on formulating arguments. This is a book that was written in the 5th century BC that Bill Belichick uses to formulate game strategy, the best NFL coach ever. Misdirection is everywhere. And so we are being misdirected by price, where the price can be dictated by the futures contracts. It should be the other way around. But where a tremendous amount of futures contracts create a perception of reality where price has not performed the way people think, and it has enabled some of the wealthiest, most influential traders on the planet to, over the last year or two, actually since 2020, start methodically draining all of the epicenters of metal. And I do believe a good chunk of it is moving eastward, never to come back. It is a one-way ticket.
Well, also all the derivatives on top of the futures contract. So there's an enormous amount of gold and silver derivatives, the most of any commodity. So gold and silver derivatives are also enormous. But I think another point here is the way the prospectuses are designed for GLD and SLV. The average person doesn't understand this because the mainstream financial media is not going to talk about it. That the bullion banks, the custodians of GLD and SLV, they're the largest holders, the unit holders of these. So if you're a regular pension fund or an institutional investor and you're a large holder of GLD or SLV, you cannot get your metal. I've heard stories in the past where there was large unit holders, an institutional investor, very large, well-respected person on Wall Street, holder of GLD, and he wanted his metal delivered, and he was told to go pound sand by the bullion banks and their lawyers. So the bullion banks have routinely, the average person doesn't understand this, they use the GLD and the SLV whenever to get physical metal around spot prices. And then they figure out where the premiums are. If the premiums are sky high, say they're $50 an ounce at the wholesale level in China, as they were a couple months ago, then if you're a bullion banker, I mean, that's an extra $16,000 for a 400-ounce bar. If you want to ship, rent a cargo plane and then ship a bunch of gold bars from New York or London over to China without getting them recast. I mean, those are enormous extra premiums for the $50 an ounce premium. You could just drain GLD at spot and then you sell the metal to whichever country has the highest premiums. And this has been going on for a long time.
Well, what you've just described is what will be the end of the COMEX, and that is going to be the Moscow platform, where they intend, as they have their finance minister publicly said, to break the manipulation of the COMEX and the LBMA. And all they would have to do is, when they said they would do an AM and a PM fix similar to what they do in London, but all they'd have to do is set gold at $2,300 day one and silver $40 day one, and the arbitrage would blow up the Western exchanges overnight. So this is a game that is coming to an end. And for the first time in my career, I believe that it is coming to an end. And when you see the commercial banks actually net long in silver futures, hoodwinking the managed money into massive shorting in an environment where getting supply is going to be next to impossible. This is why you see rhodium where it is, and palladium, because they won't screw with it. There's not enough supply to mess with it if everyone comes calling. And in years past, no one wanted to be anywhere but the dollar, and that is changing. You can see that by the groups that are coming together with BRICS. Brazil, Russia, China, India, South Africa. Recently, we've seen Saudi Arabia already sign up, Turkey, Nigeria, Argentina, Venezuela, Egypt, Mexico. They're all either expressing interest or joining, already have applied. And you're talking 85 to 90% of human population. And when you ask people nowadays, why is the dollar world reserve? Most people don't know. But the real reason that it has been the world reserve is that after Bretton Woods in 1944, when the dollar was backed by gold for other countries, the dollar was everywhere. We promised the world you could exchange it for $35 an ounce into gold at any time, until 1971, when de Gaulle from France started cashing in all his dollars and almost took all the gold, half of it, and we closed the gold window. But when we went to a fiat system in 71, dollars had already blanketed the globe. And we were the engine of manufacturing and of military might. No one would have ever challenged. And it was 3 years later when we went to Saudi Arabia to strike a deal with the Saudis and said, hey, we'll protect you and the Saudi kingdom and OPEC, but for that you value oil in dollars globally. And so since 74, every country on the planet has kept and stockpiled dollars to buy energy. The fact that Saudi Arabia not only openly snubbed Biden, the fact that they have publicly said they're joining BRICS and confirmed by the Crown Prince and by the President of South Africa last week, the fact that they have publicly last week said that moving forward this year and the next 50 years, their biggest strategic partner in oil is China, not the US. The fact that they said the only way they view the US now is in terms of protection, and you have two brain-dead senators who said the reduction in pumping oil was an act of outright aggression, and has a bill in front of Congress to remove the Patriot missiles from the United Arab Emirates, who just joined the BRICS Bank, and Saudi Arabia. Do they not realize that what has made the dollar world reserve is our relationship to Saudi Arabia and OPEC? If you realize that all of the OPEC producing countries are on the Belt Road Initiative, even the ones in South America, and the US is not. If you realize all the countries that are joining BRICS represent between 80 and 85% of human population, here's what's going to happen. You're going to get Saudi Arabia and OPEC who say, thanks for the memories, but we are now going to open up oil sales in other currencies, maybe the new BRICS currency, maybe yuan, ruble, rupee, you name it. And in a matter of seconds, all the dollars across the globe get dumped in a fashion that will be something to see, because as the dollar gets dumped globally, because you no longer need it to buy oil, and you have a currency that's backed by commodities, the dollar will get crushed. It will lose value. They will all come home creating massive inflation. And when inflation spikes, so too do interest rates, which are inversely correlated to stocks, bonds, and real estate. This is one of those moments that are different from any time in all of our lives. We are on the cusp of losing the petrodollar status. And when you see Saudi Arabia say that our main trading partner and interests lie in China for this year and the next 50 years to come, when you realize that we are going green in the Belt Road and all of the countries within it, 80+% of human population are not, why the hell would Saudi Arabia want to do anything for us? And when you see all of the things that are being put into place, including the new mBridge currency trading platform that has just recently finished a successful month-long trading beta test, the beginning of the end of the dollar as world reserve is over. And this is why I believe you are seeing a mass exodus of metal out of the ecosystem, where the biggest money in the world is using the cover of manipulated prices and misdirection of price and rhetoric to reposition themselves to all of the world's commodities and to whatever is coming next.
Well, also on the supply side, there's not a lot of incentive for the silver miners themselves, who are not getting those premiums that bullion dealers are, to bring on a lot of new silver supply, because silver prices have not kept up with inflation. They've been one of the worst performing, the paper silver prices have been one of the worst performing commodities before all the commodities futures contracts started going down the last 6 months.
Well, yeah. And look, the silver miners represent 35% of supply. Only 35% of the silver that's mined any given year comes from companies like First Majestic that specifically mine silver. And it's a hand-to-mouth business where there are very few companies with the wherewithal that First Majestic or Endeavor Silver have to be able to withhold production anyway. But even if they do, they are but a third of global mine supply. The rest of it, 65%, comes from byproduct mining of other minerals, and those companies have no interest whatsoever in playing that game. This is a game, when you talk about mining, when you talk about the way that it works right now, most of these companies, very labor and cost intensive, they are hand to mouth. They're spending tons of money. They have to dig further because silver is found in a form in nature called epithermal, very near the surface. The big deposits were found long ago, even before the advent of advanced imagery. So they have to dig deeper and go further. And the way that it works now is that when they pull the doré out of the ground, they call their bullion bank, who's lending them all the money, like JP or Goldman or Citi or B of A. And they say, here's where the refinery you need to send it to. You'll have a wire in your account in an hour. And it's bang. It's a good deal for the miners. You know, they don't have to screw around and wait 90 days to be paid. But they're prisoner in this case to the bullion banks, who then control the show moving forward. Everyone talks about the disintermediation of the bullion banks and going directly to the public. They don't have the wherewithal financially to do so. And I think that until it changes, until you have the ability for the miners to either deal in a retail capacity or deal directly to the industrials or to the public on a more efficient basis, it is the way that it is. They just don't have the money to be able to play that game. And the bullion banks make it very easy for them to not do it.
I want to also point this out because I hear this all the time, because a lot of my listeners also listen to Keith Neumeyer interviews, and he repeats this all the time, that the silver miners should form a cartel and stand against the bullion banks. Well, in the United States, it's illegal to have a cartel unless the government is making it a law and protecting the cartel. So there's a sugar cartel, I believe, from after the Civil War, and then the Federal Reserve banking cartel. And those are both enacted by law by Congress and also protected by the US government. So you cannot, in the United States, actively form a cartel to try to manipulate prices. And OPEC, that's why ExxonMobil and Chevron are not in OPEC. So they're not at the country level. They're not national oil companies, but they couldn't join OPEC if they wanted to, because then they'd be dealing with antitrust laws, lawsuits, felony charges here in the United States. So you cannot do what Keith Neumeyer proposes here in the United States for the silver miners to form a cartel. Now, maybe outside the United States, theoretically you could, but there's probably also similar antitrust laws in other countries as well.
Yeah, and one of the bills that you're seeing thrown around is NOPEC, NOPEC, which would be stripping of the what you're saying, stripping of the antitrust exemption from the OPEC countries. I mean, we're playing with fire by even throwing that kind of stuff out there, and I think it's already a foregone conclusion that that we are heading down this path. But yeah, I understand what you're saying. I mean, I think that's just hyperbole and hope, people wanting to see a change in the market.
So
that has been very frustrating for all of us.
So do you think then there's a problem with the refiners then, that the refiners are not efficient? They're not making enough blanks. They're not making enough product maybe for COMEX or for the US Mint or for you? Well, actually, could you maybe explain then, for some of your products, do you buy directly from a refiner and then do you get certain things printed, or do you buy a lot of your products from the US Mint? Maybe talk about where you source a lot of your gold and silver from.
Yeah, I would only, first of all, we are US Mint authorized resellers, so we work very closely with the US Mint, and there are 6 major mints in the world. The United States, and when we talk about sovereign mints anyway, US, Canada, South Africa, Australia, Austria, the United Kingdom. We work with all of them, and they've all been, just besieged with demand. When you talk about the refineries, I'll read something very interesting to you. Look, we have a machine that allows us to make our own 10-ounce bars, and we do that to a degree, but most of the product we buy is from very reputable and aged refineries that have a significant history behind them in terms of their what am I trying to say? In terms of their refining reputation throughout the world. So, this has been a hot button topic for the past several months, if not longer, about the bleed down of supply. And I've been talking about this for a year and a half, almost 2 years, and I've been getting a lot of crap about it because I've been saying for 2 years that the market will define itself by an inability to source product. And people were saying, I can see product everywhere. And I said, you're not understanding. People who own metal in this country represent 0.5% of the entire financial matrix. If they get concerned and you see that increase to 5%, that's a tenfold increase in demand. It's game over overnight. So I've been talking a lot about it. So about a week ago, I asked my operations to prepare something for me so that I could explain it to people like you. And they did. So I'm going to read something to you. And this is from my head trader. It says, wanted to give you a little synopsis of what we are dealing with, trying to inventory silver and wanting to help with the incredible flow that we have happening. Number 1, Umicore, one of the world's largest precious metals recycling business, is overcapacity and they won't take on new accounts. They've tried to get us on board for years. Number 2, Asahi. Asahi bought Johnson Matthey. They're in a Japanese company, but they make their product out of Salt Lake City. They won't take new customers. They can't fulfill current demands. Number 3, Metalor wanted our business for years and now can't accept any new accounts. Number 4, Geiger Mint in Germany, no more capacity. Number 5, IGR in Turkey. And number 6, Nadir in Turkey. Rumor is having political issues at the moment, cannot get much out of the country in the way of product, only dribs and drabs. Now, interesting to note as an aside, Jay, that Turkey was the largest importer of gold in the world for the first half of this year. They also are joining BRICS. Number 7, PAMP is not giving new allocations until January, nor is Valcambi. Both are concerned about energy into the winter. These are Swiss companies, Swiss refineries that are worried about the energy over the winter and being able to keep the lights on. Number 9, the Mason Mint. Their production numbers are very small. 10, the US Mint, as well as anyone. So, I could keep going on about the supply chain problems, but here you have 9 or 10 of the biggest refineries in the world that are just not sending anything out, not taking on new accounts. If you're not established with them, you're screwed. If you're not able to send a wire for 10, 20, $30 million, you're screwed. If you can't hedge what you buy because you're not going to get it for 30 days, you're screwed. So it's a situation where getting clients is far easier these days than getting product. And again, starting at the very top, the LME, the COMEX, backdooring out of the ETFs like SLV by the authorized participants, the wholesale, the refineries, the sovereign mints, the secondary market. No one's selling anything. Do you see a trend here? Supply is disappearing right in front of us. And if you don't notice it and you're waiting for a pullback to get in, you're going to wake up and find out that everything's gone.
Well, if silver prices a couple months ago had gone below $18 down to $15, $16 an ounce, I mean, a lot of the silver miners, even the base metal miners right now, Andy, are running cash flow negative because the base metals are in a bear market and their costs are up with labor and energy and diesel and electricity and those things. Is very energy intensive and labor intensive to do base metal mining with low grades. So we're looking at supply problems for silver byproduct, although we've had a little rally lately. But I mean, even with this little rally in the paper price in silver, there's no incentive for a lot of these silver miners because the paper silver price is not keeping up with inflation in the mining industry, the official government inflation rate. There's no incentive to bring on new supply. So what you just described then is immense supply chain problems. The miners, the average person out there thinks that the miners are the ones causing the problems because the miners, they don't understand that the refiners buy these doré bars. So that most miners only make doré bars, which is what a mix of gold and silver. And then the refiner buys these large doré bars from the miner, normally at a discount. They haggle. And then these doré bars, which are giant gold and silver bars, but they're not refined enough for retail or for industry. And then the refiners are refining the doré bars down, separating it into gold and silver coins and bars for retail investors or for industrial purposes.
That's true. That's all true. That's all true. And there's a lot of people touching it along the way and a lot of money involved in doing it. So yeah, it's I think the goal of a lot, or the aspirations of a lot of people who have big visions, would be to disintermediate some of the people touching this, in particular the bullion banks, and have the miners refine their product themselves and then sell directly to the industrials and to the end user. And that vertical integration sounds like a great idea, but in practice, it's too costly, and really is not something that I see coming anytime soon. As much as it would be wonderful to be able to do that, these mining companies are publicly traded companies that are at the behest of their shareholder too. So they have to show a profit, and the way they do that is by selling metal, and the way they do that is by pulling it out of the ground and getting rid of it as fast as they can. So as much as we'd like them to make it, to stand up a little bit more to what's going on, and you think they should, it's been my experience that very few people have. Keith Neumeyer has at least been a voice to stand up to it, but he's just one person. The industry in and of itself, I think they lack the ability and really the desire in many cases to do this because of the consequences it could have.
So I've heard for years just a bunch of different types of problems at the U.S. Mint. So for years now, the U.S. Mint, I don't know if they're still doing this, but they were doing this for years. They would close down production before Thanksgiving for the entire year. So a normal private sector business, if you closed for almost the last 2 months of the year, that's not good business. So even if there's more demand for your product, more demand for silver coins and bars, for American Gold Eagles, those things, the U.S. Mint still closed down. And then recently, the last 18 months, I would say, at least, there's been problems the U.S. Mint has disclosed publicly with sourcing silver blanks. Are these problems still bad, or are they getting worse? Or what do you think could be done maybe to fix these problems with the U.S. Mint, maybe so my listeners out there could potentially actually get silver eagles at lower premiums?
Well, the rumor is that Janet Yellen would have to allow the mint to pay a higher price for the blanks. So basically, the rumor is that they are only allowed to pay, the average asking price of what silver is trading at by buying these bars or whatnot, and then they're the 1,000-ounce bars, which are then turned into planchets by Sunshine Mining. Well, look, Sunshine Refinery, who provides the blanks to the U.S. Mint and a couple other sovereign mints, I think is just not wanting to sell the blanks at spot when they can get a whole hell of a lot more elsewhere. And so, I don't buy it's just stupid, because the other mints have been, since 2020, since January, February 2020, the premiums have been north of $10 an ounce forever, have never come back down. And, the whole time, Krugerrands, I think, and I do believe Sunshine makes the blanks for the Rand Mint. Kangaroos, Britannias, Maples, they've all been way cheaper and way easier to get than the Eagles. But like I said, the demand for silver has been extraordinary, Jason, and represents 95% of all the business companies have been doing for the last 3 years. And I'm talking $500 million, 600 million, in sales in 2020, more in 2021, and more this year. And it represents 80, 90, 95% of all the sales everyone's doing. And for the U.S. Mint to come to us in June and say the second half of the year we're curtailing gold production by 50% was just ridiculous, because for the past 3 years, it's represented but a tiny amount of the overall demand. So the question is it something deeper than that? Are they trying to mitigate a run on the dollar to make it difficult for Americans to get Eagles? I don't know. Are they just completely inefficient? I don't know. But they're not limited to the same, you have to buy silver blanks from US-based resources as they are with gold. They can buy it wherever they want. So I don't know.
So the rules are for the silver blanks, they can only buy from certain American refiners. And so those are the rules, but you said the rules are different for their gold blanks?
I believe they can buy the gold wherever they want, and the silver, they're supposed to source it from American companies, and they buy it from Sunshine. And, the fact that they are saying they can't get the blanks, to me is ridiculous. Because the demand, if they would just pump them out. Look, in 08, 09, I don't remember the years, but they were making 50 plus million Eagles a year. And now they're making 14, 15 million this year. They're running at a third the capacity that they could.
I've unfortunately compared the U.S. Mint to the Department of Motor Vehicles. It's that inefficient. I mean, why close down for 2 full months? Why not hire workers and pay them some overtime bonuses, get government approval, go and sell those silver Eagles at premiums? The government could actually make a nice profit, even if the premiums went down a little bit. I mean, the government would still have some nice profit selling more silver. It just doesn't make a lot of sense to close down your business for 2 months when there's demand for the product that the government is the mint is selling.
Of course not. Doesn't make sense at all. I completely agree. But most of the things that our government does these days makes no sense at all. And I could make the blanket statement that the U.S. has done more to destroy itself in the past few years than any external enemy could have ever done.
Oh, I agree. I live right outside of DC. I completely agree. It's both political parties. Neither one wants to stop spending, actually.
Right. It's crazy.
Yeah, we're our own worst enemy. DC, the parasite that is the Washington, D.C. metro area, and both political parties and the bureaucracy here. No one's really talking about cutting spending.
The people in this country should be outraged. I mean, 1 trillion seconds ago was 31,688 years ago. I mean, the numbers are so big, we're screwed.
Well, we're headed Andy, and we're headed next year. If the Fed keeps hiking interest rates, we're headed next year in 2023 towards 1 trillion per year in interest payments just on the debt. So that won't cover. That's more than the official annual defense budget. That's insane just for interest payments. 1 trillion per year.
It's beyond insane. It's beyond insane, and that's part of the problem. And I think, you know, what happens if the dollar gets dumped and interest rates really spike? That's the Great Reset right there. And
well, I think, unfortunately, with the history of governments and central banks, it's more likely that the Fed will have to lower interest rates, and then they will have to monetize more government debt. The dollar is too strong right now. So at some point, the Fed's going to want to weaken the dollar. We're already seeing that there's a lot of evidence, Andy, that there's not demand anywhere near the demand for U.S. Treasuries that there was from foreigners. So foreign demand is really non-existent. So at some point, the Fed's going to have to come in, and they're going to be the buyer of last resort of U.S. Treasuries.
But the end result is the same thing. The end result is, if you go down that path, then that's monetization of the bond market, which is Weimar Republic Germany, which leads to hyperinflation and skyrocketing interest rates. You can't be the buyer of last resort in a globalized world. You lose. This is why I think you're seeing the countries rally. Part of the reason you're seeing them rally the way that they are into a commodity-backed currency that the BRICS announced will challenge for world reserve. If no one is buying our bonds, and the only way you keep interest rates low is by creating money, printing it, to buy the bonds to lower money, you create hyperinflation, which raises rates in and of itself. And you can lie about the metrics by which you are calculating inflation, as every nation wants to do. It's their vested interest to print as much paper as they can and keep rates low by lying about the numbers, the way we do. But at some point, the world says, F off. I'm not taking your dollars. I ain't buying your treasuries. I don't want any of your crap. Pay me in gold. Pay me in the new digital yuan, or we're in the new BRICS currency. I don't want it. And that's when the rubber meets the road. So yeah, they can pivot. You can see that in the inverted yield curve. The smart money thinks that's what's going to happen. I get it. But then they lose all credibility, and you have chosen hyperinflation over austerity, over the tough decisions, the way all politicians have forever. But that's why we're getting very close to the end game. And that's why you own metals, not to get wealthy, but because it is wealth, Jason, that's outlived 2 world wars, German hyperinflation, and the Great Depression, and every pandemic. And this is the time more than ever to own it. And I think that's why you're seeing so much of it leave and be accumulated, even though price wouldn't dictate it. And quite to the contrary, price has been being used to allow the smart money to accumulate it and take possession of it while no one notices.
Yeah, it looks like LBMA, COMEX, GLD, SLV, all these things are being drained, and the metals being sold by the bullion banks or whatever entity into other countries for higher premiums, that this scheme is only increasing lately.
That's exactly right. And you're using misdirection. Look, if you're going to try to do something, you know, you're playing any game, anywhere you have an opponent, you want to fool them and misdirect them, point them in the wrong direction. And that's exactly what is happening on a very large scale here. And don't know who exactly it is pulling the strings, but it's very obvious to me that the price is detached from the demand and the desire to take possession and remove counterparty risk, and it from the very highest levels on down. That, to me, is far more illuminating than the refineries, the government mints, and the retail market becoming very, very, very sparse with product.
Well, Andy, I really enjoyed our discussion today. If my listeners want to take a look at your work, maybe take a look at Miles Franklin. I used to blog. Are you still writing blog articles, or are you just mostly doing interviews these days?
Yeah, I'm doing about 8 or 9 interviews a week. We have a website that is really old and decrepit. We've, for the past almost a year, have been building a new one, which has been a series of setbacks and disappointments. I am being told we're close, maybe even by the end of this week, doing our soft launch on our new milesfranklin.com website, which will allow online purchasing. For the past 2 years, our prices have been as good or better than anyone in North America. I have seen this coming. I am friends or friendly with Chris Martenson, and when he talked about COVID in 2020, from that day forward in December, I understood he's a very, very smart man, not just an economist, but an epidemiologist. And I loaded up, went out on lines of credit and bought everything I could as far into the future as I could. And I've maintained that ideology for the last 3 years, nearly 2.5, and mostly in the form of bars, 10 ounce, kilo, 100. Of course, I do have the sovereigns, but supply is getting tight. If people would like to get a current price list, send us an email at info@milesfranklin.com and mention this show in the subject line. And we'll make sure your listeners are getting as good of a price as they'll find anywhere in the country. And our availability is probably better than most. We'll answer questions if there are any, call you back if you want to be. And again, before the end of the year, we'll have a new website that will allow for online purchasing. But I still believe in being old school and developing a relationship. I've done this for 33 years. And I think where we're going, relationships will be very important. And I don't think you understand how important one is until there's a problem or you really need help. And we're really good at that. So info@milesfranklin.com. We'll send you info on our company, a current price sheet, answer any questions if there are, and put in the subject line that you came from this show, and we will make it a good experience. That I can assure you.
Excellent. Well, thank you for taking the time and coming on and talking about the supply chain problems in silver with refiners. It does not sound like the supply chain problems are going to get better in the next 6, 12, 18 months.
No, I don't think so. In fact, I think they're going to get much worse. And again, I'll leave your listeners with one thought. My friend Rick Rule always says that if you take the entire allocation of precious metals, and he just said this again recently, from the Harvard Endowment Fund down to Joe Sixpack, the allocation to metals is 1/2 of 1%. In 1980, with $800 gold and $800 or 800 on the Dow, the last time they crossed with a 1-to-1 ratio, that allocation was 8%. The 40-year mean is 2.5%. Just getting to a 2.5% allocation on average across the U.S. financial matrix would represent a 5-fold increase in demand.
Well, yeah.
And it's game over at that point, long before it gets there. So it's real and it's happening. And again, you don't buy precious metals to get wealthy. It is wealth. If you own enough of it, you'll be wealthy. But you're doing it, you're buying it, you're owning it, you're thinking of owning it to get out of the way of whatever is coming. Just like whatever and whomever, the biggest money around is draining these exchanges, doing exactly what they're doing, taking possession before it becomes a problem, before it's in your face.
These pension funds and these endowments, that's funny you brought it up. I mean, they don't own any, there's very few pension funds that actually own any physical gold. Most of them have put on these ridiculous, overly leveraged hedge fund trades. We're seeing in the news stories today that some of these large pension funds, I think the largest one in Canada, the Ontario Pension Fund, I think they had bad investments in some of these crypto exchanges that are becoming vaporware and where there was billions of dollars stolen. So they're going to have enormous losses or write-downs. They should have been hedging maybe with some physical gold and silver. Instead, they got greedy and put on these leverage hedge fund trades and then dramatically over speculating in crypto from what it looks like.
Not only that, all the bonds they've accumulated over the last several years are being eviscerated as rates rise. At what point do they have to sell those positions? And that only makes rates go higher. This is a vicious loop where when you manipulate interest rates to the degree that the West has for so many years, and then pump money into the system, and worse yet, pay people to sit around, play video games, and eat bonbons, you create such massive distortions in assets and in resources and in capital that when there is a equilibrium in interest rates and asset prices, when this happens, it's going to be a religious experience, and it will start with the pension funds and the insurance companies, just like you saw in the UK, and they had to come in and bail them out. It's going to happen here too. And when that happens, you can rest assured it signals that hyperinflation will be the choice over letting Mother Nature, just like she does in a forest fire, clean the underbrush. And it should have been cleaned in '08. Instead, they just papered it over. And when it burns this time, it's going to be far worse than it would have in '08, where we would have been on our way to prosperity again. But just remember this, in '08, the balance sheet of the Federal Reserve was $800 billion. It's $9 trillion now. That nearly over 8 trillion in added assets to the balance sheet of the Fed has all been in interest rate bearing assets like US Treasuries and mortgage-backed securities. Why? Because that stabilizes the bond market, it suppresses interest rates, and it incentivizes people to speculate into real estate, into crypto, into equities. It pushes asset prices sky high, but all of it is an illusion fostered by manipulation of interest rates. And when it finally corrects, when Mother Nature has her way, when the bar tab has to be paid or the fire gets set in the forest that can't be put out this time, the institutions like the insurance companies and the pension funds are dead in the water, and more so than most, because their allocations have all been in bonds and in equities and in things that will be inversely correlated to that spike in interest rates. And that's why you're going to read more and more of this kind of stuff as time goes on.